if you have a lot of your money in something that's yielding you 1%, well, if inflation stays at 6 or 7%, you're way behind the curve. So that's the challenge with having too much of your money in bonds. Yes, it's going to help to minimize fluctuations, but it's also going to severely limit your return, which in retirement is also going to limit your ability to keep pace with inflation.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This week I'm addressing another listener question, and this question comes from Jen. And Jen writes in that she wants to know what her asset allocation should be in retirement. So thanks, Jen, for the question. And as a reminder, for any listeners that have a question, you can go to retirewithryan.com and click on the contact button and type your question there, and we'll consider that for a future episode. So in this episode, I'm going to talk about what asset allocation is and how you should approach that as you are saving for retirement and even in your retirement. So firstly, what is asset allocation? And for any of you who have attended my retirement readiness workshops, you might have remembered me saying that this is one of the single greatest decisions that an investor has to make, and it will have a large impact on the outcome of your investment portfolio. And if you Google this very question, what is asset allocation, you'll come up with a lot of different answers. But the basic premise is that you are dividing your assets amongst the different asset classes, most commonly known as stocks, bonds, and cash, to manage the risk in your portfolio. The more that you have in stocks, the more that you allocate towards stocks, the greater your potential for growth is, but also the greater potential fluctuation is. And a lot of people then go beyond just those three main asset classes and will potentially invest in real estate funds or also commodities to further diversify their portfolio. The premise is that the more asset classes you invest in, the greater diversification you have, and this will help smooth out any declines that might occur. Let's just say, for example, the stock market went down, but the commercial real estate market was doing well, then that would help to maybe keep your portfolio from having as much of a decline if you just were only invested in stocks. The problem with part of this, and I'm not telling you not to diversify, is that what we've seen in recent years is that there's a very high correlation between many of these asset classes, meaning that when stocks go down, usually commercial real estate goes down and also commodity prices go down. It used to be that you could count on commodity prices staying higher, such as gold and other precious metals, when the stock market went down, but you don't always see that. The second thing is that how do you go about determining your asset allocation, right? The premise for this question. Well, there's different ideas about this. One of the most commonly thrown out, quick back of the napkin ways to do this is by taking your age and subtracting it from 100, and that remaining number is the amount of money that you should have invested in stocks. So let's just say you're a 65-year-old, you take 100 minus 65, that gives you 35. That would mean you'd want to have 35% of your portfolio in stocks. There's some major problems with this. One is that 35% in stocks is a very conservative portfolio, especially for a 65-year-old. And a 65-year-old retiring today is probably expecting to live 25 to 30 years or possibly longer in retirement. And one of the greatest threats to a successful retirement is your money keeping up with inflation, keeping its purchasing power. And as we've seen recently, as announced by the federal government, inflation in the U.S. is close to 7% measured over the last year. So if you have a lot of your money in cash and bonds, that is not going to come close to keeping up with inflation. So therein lies the challenge with having such a small amount invested in stocks. So this formula has been updated, I would say, in recent years. Instead of using 100, you probably should use 110 or maybe 120. So let's just say you were using 120 for the same 65-year-old. That would give you 55. That would tell you you'd want to have about 55% invested in stocks. So I would feel better about that for someone at a minimum, because now you have somewhat of a chance to keep pace with inflation. But that other amount of money that you have in bonds, that's the challenging part because bond returns are always going to be highly based on where current interest rates are. And as we know right now, current interest rates are at a very low point, right? If you go to your local bank and you want to invest your money in a CD, you're not going to find a very good return for you with that, probably at all the time, especially now. So I went online, I went to bankrate.com, I looked at the CD rates, and as I'm recording this show, the best I see here for a short-term CD under 2 years is 1.25%. So let's just say 1%. If you have a lot of your money in something that's yielding you 1%, well, if inflation stays at 6 or 7%, you're way behind the curve. So that's the challenge with having too much of your money in bonds. Yes, it's going to help to minimize fluctuations, but it's also going to severely limit your return, which in retirement is also going to limit your ability to keep pace with inflation. So I think there's some flaws in that rule. So there's really two main other inputs or considerations that you should have when putting together your asset allocation. One of them is time horizon, and the other one is your tolerance for risk. So regarding time horizon, it's just what it sounds like. The more time that you have, generally, the more risk that you should take. And why should you do that? Well, one reason is what I mentioned before, inflation. You want your money to keep its purchasing power. So that means you're going to need to have more allocated in stocks over the long term, or I should say stocks, real estate, and commodities. And the more time you have, the more time you have to recover from a stock market decline. If you've been investing for a while, which is chances are high that if you're listening to this, you're getting close to retirement, you've been through multiple bear stock market. Bear market meaning stock market decline. And the stock market decline doesn't last forever. Stock prices do come back, but it could take a number of years for the price of those stocks to come back. It could take a short period of time, like we saw recently in last March or 2 Marches ago, March of 2020, things came back relatively quickly, or it could take a number of years, 2, 3, 4 years. So if you have more time, you have more time to recover. I think some people make the mistake of thinking that, okay, I'm retiring, so I'm going to need my money. Yes, it's true you're going to need some of your money, but most of your money you're not going to need. You're going to have the majority of your money invested and you're going to be living off of it during your retirement. So you need to think about the time horizon for your retirement. As I mentioned before, it's probably 25 years plus for most people based on just average life expectancies. There's a second major thing to think about is your tolerance for risk. And what do I mean by that? Everyone is comfortable with different amounts of fluctuation in their portfolio. Some of us aren't comfortable to see any decline in our portfolio, and that really causes us to lose a lot of sleep. Other people are completely comfortable with large fluctuations in their portfolio. You have to know yourself and know how you've reacted based off past declines in your portfolio. And it might be a little different in retirement because chances are when you're retiring, you're going to have accumulated the largest amount of assets you've ever had in your life because you've been saving up all this time to now start spending. So you really need to understand the trade-off in your investment portfolio, your asset allocation between the risk and reward. And a good way to do that is to look at past markets. Now, stock market declines don't always repeat themselves. In the last 20 years, we've had 3 major stock market declines, 2000 to 2002, 2008 to 2009, in February of 2019. And I think the 2008 to 2009 would be the best one to focus on because that was the greatest decline and it was also one of the slowest recoveries as well. I think the 2008 to 2009 decline would be a good reference point to look to see, based on your asset allocation, what is the potential decline in a worst case scenario if we did have a repeat of a 2008, 2009 scenario. And I'll put a link in the show notes to a Excel sheet that I put together that looks at different asset allocations from this period. And I put this together using an S&P 500 fund and a total market bond fund. And if you look at a 100% stock portfolio, the maximum decline would have been about 44%. So we put that into dollar terms. If you had $1 million invested in the portfolio going into 2008, 2009, you'd have seen about a $440,000 loss. That would have probably bothered many people, right? So the more you add into bonds, the less of a loss that you see, but you also see less of a return. So let's just say you had 80% in stocks and 20% bonds, you would have seen a 35% decline. If you had 60% in stocks, 40% in bonds, which is a very common asset allocation for a lot of people, especially going into retirement, you would have seen about a 25% decline. So you have to balance this out to know what the potential decline is and how that's going to limit your return. Because by having about 40% in bonds versus, having none, if you had an all stock portfolio, you would have had about a 1% lower return per year in the preceding roughly 10, 11 years after the decline. So it's a balancing act. You are creating more safety, but you're also limiting your return. So I would say that in a vacuum, you'd want to have as much money in the risky investments as you could because they offer a much greater return, especially now that the interest rate on bonds is so much lower than it has been in the past. But we don't live in a vacuum, right? We live in the real world where percentages don't sound like much. A 20% decline might sound okay, but if you've got $1 million portfolio and you see a $200,000 decline, but you've got to be comfortable with that. So that's where it's really important that you understand what your current asset allocation is and you balance that out with your tolerance for risk. You also can determine how much income you're going to need in retirement. And let's just say you had a $1 million portfolio, you're taking out $40,000 a year of income in your portfolio. You could consider setting aside at least 5 years of income, which would be about $200,000, and keeping that in cash and bonds. Now, why 5 years? Because the average stock market decline takes about 4 years to recover. So that would give you 5 years before you'd have to actually sell any of your stocks to let them come back. So that's definitely something at a minimum you should consider. And then from there, it's really up to you and your tolerance for risk and the trade-off, right? You have to balance out the fact that the more you have in bonds, you have less fluctuation, but you also are going to have a lower return going forward, especially during this challenging time where the return on bonds is much less than it was in the past. You really can't look at past returns of bond funds until our interest rates go much, much higher, because in the past, interest rates were higher and you had a much higher return on your bonds, whereas today, your return is a lot lower because it's based on interest rates. So what are the steps you want to take to actually create this asset allocation? Well, first thing would be to understand what your current asset allocation is. And you can do that by digging into the funds you own, using something to give you your asset allocation. Sometimes 401k companies will put that right on your statement, or investment companies will put that, or the help of a financial advisor to help you determine that. And then from there, you want to figure out what your ideal allocation should be. And again, a financial advisor can be very helpful for that. Or if your 401k provider has a risk tolerance questionnaire, you can fill that out. There's some free ones online. Like I recommend people, if they're looking for a free one, you can check out Vanguard's. I'll put a link to that in the show notes. But all these other things that we talked about really need to factor into that, because what I've seen from doing this for 20 years is that I have clients fill out asset allocation questionnaires at different times. And based on how they're feeling, they might answer the questions differently. If the markets are at a high and you're doing well in your investment portfolio, you might be more comfortable with risk. But if you fill it out when things are declining, you might be less comfortable with risk. And therefore, you might get two totally different results. So you really have to factor that in. Additionally, there's also some good books out there about asset allocation, two that I recommend. One is The Investment Answer by Dan Goldie and Gordon Murray. I'll put a link to that in the show notes. And there's another great book called Simple Wealth, Inevitable Wealth by Nick Murray, which really helps put into context the risk-reward trade-off of owning stocks. And you can find both of these books probably at your local library, or you can buy them on Amazon or maybe other used book sites. So thanks again, Jen, for your listener question. And as a reminder, if anyone else has a listener question, you can go to retirewithryan.com and click on the contact button to enter your listener question. And as a reminder, my retirement readiness workshops are starting up again in March and April. And also, if you go to retirewithryan.com and click on retirement workshops, you can find the link to those where you can sign up to attend. If you haven't attended in a while, could be a good refresher. Or if you have a friend who's looking for help with retirement planning, this would be a great suggestion to refer them to this course, and they can get a lot of good information about planning their retirement. These are going to be taking place in person, which I'm excited about. That could change, if another COVID variant comes, but they will be taking place in person. So thanks again for listening this week. I look forward to talking to you next Wednesday. Have a great week.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.